Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to the important events on the horizon. Let's start with what moved markets this past week. Three important themes shaped the investing landscape, and we want to walk you through each one. The biggest story this week was the continued acceleration in AI spending. Meta announced an expanded $21 billion commitment to AI infrastructure, joining a growing list of major technology firms making large-scale bets on the future of computing and data. This level of investment signals deep confidence in long-term growth opportunities, particularly around advanced computing capacity and next-generation data infrastructure. For our portfolios, this momentum reinforces our conviction in owning the companies at the center of this transformation. Businesses with proven technology, strong balance sheets, and direct exposure to one of the most powerful growth trends of our time. U.S. equity markets have shown notable resilience through a complex macro environment, holding up better than many investors expected. Inflation expectations remain well anchored near 2.3%, which has helped support growth-oriented valuations, and recent consolidation in large-cap technology has created what we see as more balanced entry points for long-term investors. We continue to focus on high-quality companies with durable earnings, businesses where strong fundamentals can carry performance even when markets are working through uncertainty. This disciplined approach is exactly what this environment rewards. Capital markets activity has been quieter in recent months, but early signs point to a meaningful re-acceleration ahead. SpaceX's anticipated IPO, potentially one of the largest in history with a valuation approaching $2 trillion, is already generating significant investor interest and lifting sentiment across related sectors. A launch of that scale could act as a real catalyst for renewed deal activity and equity issuance more broadly. We see this as a constructive signal for financial markets and for the businesses we own that benefit from healthy capital market conditions. Now let's look at what drove our portfolio performance over the past week and why we remain confident in our positioning. Meta was our top performer last week by a wide margin, surging 9.39% as investors responded strongly to the company's continued strength in digital advertising and growing confidence in its AI strategy. What makes Meta stand out right now is its ability to scale AI infrastructure across its platforms, Instagram, Reels, and WhatsApp, while maintaining the kind of cost discipline that drives meaningful operating leverage. Importantly, Meta's forward valuation remains attractive relative to other mega-cap technology companies, making it a compelling combination of strong near-term earnings and long-term AI upside. It's a great example of the quality businesses we work hard to identify and own for our clients. The financial sector led our portfolio performance this week with broad strength across our holdings. Morgan Stanley gained 4.25%, Royal Bank of Canada rose 3.3%, and JP Morgan Chase added 2.85%, with Goldman Sachs, BlackRock, and Bank of America also contributing positively. Stable interest rates, resilient economic activity, and firm trading and capital markets revenues are all working in the sector's favor right now. Looking ahead, improving deal pipelines and strengthened wealth management provide additional upside, and we remain confident that our high-quality financial holdings are well-positioned to continue delivering for clients. Our size strategy was the week's strongest contributor overall, with concentrated gains across our mega-cap and large-cap holdings. Amazon, Alphabet, Nvidia, Meta, and Royal Bank of Canada all delivered meaningful returns, reflecting continued investor preference for large, financially sound businesses during uncertain times. These companies benefit disproportionately from the AI investment cycle, have the global reach to capture diverse opportunities, and hold the balance sheet strength to keep investing through periods of volatility. This dynamic reinforces our conviction in category-leading businesses built for long-term durability. Looking ahead, here are three key events we're monitoring that could shape markets in the coming week. Monday brings February's existing home sales data, which came in stronger than expected at an annualized rate of 4.09 million units, well above the forecast of 3.89 million. Falling mortgage rates are drawing more buyers back into the market, and the NAR's chief economist noted that improving affordability is beginning to generate a real consumer response. Housing is a key driver of broad economic activity, and a recovery here supports spending across construction, financial services, and retail, making this an important signal for the economy heading into spring. Tuesday brings the Producer Price Index, which tracks the prices businesses pay before goods and services reach consumers. February's reading came in hotter than expected, with prices rising 0.7% month over month and 3.4% year over year, the highest annual figure in a year, led by increases in food commodities and fuel. Markets have shown resilience in the face of price pressures, but we will be watching for any shift in Federal Reserve rate expectations as investors process this data. Thursday morning's jobless claims report continues to be one of our most reliable real-time reads on the health of the labor market. Initial claims for the week ending April 4th came in at 219,000, slightly above expectations but well below historical averages, while continuing claims dropped to 1.794 million, the lowest level in nearly 2 years. This ongoing employment strength supports consumer spending and corporate profitability and continues to reinforce our positive and constructive view on equities. Thanks for joining us, and we'll see you next week.